Well, welcome everybody to the second day of the 29th annual Hyman Minsky conference. We open the second day again with a member of the Federal Reserve Board, Mr. Robert Kaplan, who is the President and Chief Executive Officer of the Federal Reserve Bank of Dallas. And he represents the 11th Federal Reserve District and the FOMC, the Federal Open Market Committee, which is the monetary policy body of the Federal Reserve. I want to publicly thank him for agreeing to participate in this conference. And I want to say a few things about him. He's a prior academic who was at the Harvard Business School, and also reminds me of my own because he was also part of the administration, an associate dean at the Harvard Business School. He had a chair there, the Martin Marshall Professor of Management Practice, and he was there for some period of time. But prior to that, he was in the world of finance, being for 23 years associated with Goldman Sachs, being the vice chairman of the firm, and also with the responsibility of global banking and investment. So he's certainly a seasoned executive in dealing with issues of finance. He's a member of a number of boards, nonprofit boards and philanthropic, and also including the Harvard Medical, member of the board of the Harvard Medical School. He holds degrees from the University of and the Harvard Business School. So after his remarks, there will be a Q&A period, which will be moderated by a seasoned economics editor, Deborah Solomon, from the New York Times. Mr. Kaplan, again, thank you, and the floor is yours.
Thank you, Dimitri, and thank you, Deborah, for moderating this conversation. I'm just going to lay out probably 8 to 10 minutes of points just to set the table, and then I'll throw it back to Deborah for the Q&A. And I'll get right into it. Our forecast at the Dallas Fed is that the United States will grow at approximately, GDP will grow at approximately 6.5% in 2021. I'm very conscious of the fact that there are private forecasters and other forecasters that have forecasts even higher than that. And so I'd say if there's risk to our forecast, it's likely to the upside. Consistent with that forecast, it's our judgment that the unemployment rate will drift down throughout this year and will approach 4%, may even dip below 4% by the end of the year. I'll come back to that because a lot of the unemployment forecasts depend heavily on your assumptions on participation, labor force participation. I think we've got a number of tensions and frictions going on right now with labor force participation, which I'll talk about. On inflation, our base case forecast is that we'll see a surge in year-over-year PCE readings in May, June, July, through the summer. The number of reasons for that, one of the reasons is a base effect, so-called quote-unquote base effect, i.e. Because of all the excess capacity a year ago and weakness in inflation readings, it's not surprising you're going to have a significant surge year over year as we reopen. The base effects will start to wane as we get into the fall. There are other things going on though with inflation. I'll probably leave that in an in-depth conversation regarding that to the Q&A with Deborah. But some of these effects I think some of the effects, the base effects will be transitory. Some of the supply demand imbalances that we're seeing, logistics, supply chain issues that we're seeing in our extensive outreach with businesses, some of them will get resolved in the next 12 months. And I will tell you, and we'll go into this in the Q&A, a number of the contacts I talked to where they were more confident about these supply demand imbalances getting resolved within 12 months. They were more confident about it, say a month or month and a half ago. I'd say many of them are expressing greater uncertainty about how long it will take to resolve those imbalances. And then we've got other issues broadly with input costs and other frictions with ability to hire workers. So the bottom line is our base case forecast is we'll get a surge in the summer months. We still expect that year-over-year PC inflation readings will end this year in the range of, say, 2.25%. So moderately above 2%. And we're watching this, and we'll watch it very, very carefully because we've got a number of factors here at work. Few things about that make this pandemic and the recovery unusual, and certainly, in my view, very different than the experience we had after the Great Recession, and very different than the 2011-2013 period. One of the key differences and key issues is normally when you have a downturn or a recession, like we did in the Great Recession, household income drops. And what goes with household income dropping is consumer spending drops, and you get the so-called recessionary effects, the ripple effects. We did not have that this time. We had a severe contraction in the second quarter of 2020, and then we started to rebound in the third quarter and the fourth quarter. But household income and consumer spending have stayed relatively solid through this entire period. Why? Substantial fiscal support, much greater as a percentage of GDP, much more rapid and much greater in size as a percentage of GDP than we had in the Great Recession. And obviously there have been a few waves of that fiscal support, and there may be more fiscal actions coming that have not yet been passed. But the point is, household spending stayed strong in 2020. It continues to be strong today. The consumer and household balance sheets are in much better shape today, not perfect, but in much better shape than they were in the aftermath of the Great Recession. And so that makes this, that's one of several factors that makes this very different. A couple other comments I would make. I don't need to tell people in the audience that the pandemic has affected different types of businesses in a very different way. If you're in a business that relies on person-to-person contact and you can't use technology to serve your customers, what's an example? You can't do, if you're a restaurant, pre-ordering and pickup to substantially change the mix of your business, or you run a movie theater, or you're in other forms of leisure and hospitality, hotels, others. 2020 was a very rough year for you. And if you're in the restaurant business, it's starting to meaningfully pick up, but there still are segments of leisure and hospitality, person-to-person contact industries that have not yet recovered, or have recovered in certain geographies, but not fully in the United States. So that's on the one hand. On the other hand, if you're in a business where you were able to use technology to serve your customers or your clients, you might have had a record year in 2020, and you're probably doing very, very well today. And the goods producing industries versus the person-to-person service sector industries have also done very well. At the same time, the pandemic has also affected different groups in the labor force very differently. If you've got a college education or greater level of educational attainment, it is far less likely that you lost your job. It is much more likely that you're in a job, you were able to successfully work remotely. And you may have also had a very good 2020, and you might be doing very, very well in 2021. And it may be very possible that you have savings or an IRA or other accounts that are invested in the market, and you benefited from that. On the other hand, if you're one of the 46 million workers in this country with a high school education or less, it is far more likely you worked in a person-to-person contact industry. It is far less likely that you were able to work remotely. You might even, in some cases, not have access to Wi-Fi. And it is far more likely that you lost your job and you lost income, and the fiscal support was what allowed you to make it through this and make ends meet. While sectors of high school and less, and again, I would note without a skill, lower skilled workers are recovering, that recovery still relies heavily on the recovery of the person-to-person contact business and leisure and hospitality. And so we're watching that very carefully. If you're a working mother, in the Great Recession, working mothers fared about on par with their male counterparts. Not this time. If you're a working mother, we have seen the participation rate for women with children, prime age workers, decline by in the neighborhood of 4 3/4 to 5 percentage points. That is a substantial decline. Obviously, reasons are need to, care for children who can't be in school in person. Lack of access to childcare is another issue. And so the point of all this, we've got a lot of work to do as we recover to get those with high school educations and less back into the workforce. We hear from junior college superintendents that enrollment in skills training for many of them has dropped precipitously, particularly among Black and Hispanic students. It's going to be very important to get that enrollment back restored. For many of those students, you need a part-time job to help make it possible to be in skills training, and you need access to Wi-Fi. And that's why we're also talking about the need for schools to reopen in person, at least by the fall, and access to childcare and some of these other factors as key to helping working women get back into the workforce. I probably used up about 10 minutes here. Probably in the Q&A, Deborah, I'd probably like to go through this dichotomy we have between, we've got over a 3% drop in the employment to population ratio, yet when you go out to businesses today, they will widely tell you they can't find workers, either low skilled or skilled workers. And we're doing a lot of work at the Dallas Fed, and I might try to explain that dichotomy, but let me throw it back to you, and then I'll take your lead and we can go through some more of these issues.
Sure. Well, thank you. Thank you so much for being here and having me moderate. I do want to get to that question. First, I want to talk about something. I know we're going to talk a lot about inflation, but I want to start with a different yet related issue, which, given some remarks you made last week, in addition to keeping rates near zero, the Fed has been buying $120 billion in government-backed debt per month. Fed Chair Powell has said it is too soon to even start talking about tapering or scaling back those purchases. You gave an interview in which you said you think it is time to start talking about, tapering. And I was wondering if you could expand a little bit on your thinking and why you think, now may be the time to start talking about either, letting the balance sheet roll off or what you might think the Fed should do, and when they should start doing it.
So let me reiterate again with precisely with what I said to your point. What I said is I'd like to see us begin talking and begin discussions to talk about how to tapering sooner rather than later. Or I think I may have said it at the earliest opportunity, but sooner rather than later. Okay, so why am I saying that? I think when 80 billion of treasuries and 40 billion of mortgage-backed securities, when we started this program, I thought it was vital for it to help restore market function and to help enhance and speed the recovery. These were extraordinary measures, but I thought they were appropriate, very appropriate. And I've continued to feel they were appropriate. In December, we, as a group, and I supported this, said that we had a substantial further progress benchmark that would need to be met. We left it deliberately ill-defined, and it's going to be subject to some debate, but we did that. Okay. Since December, a lot's happened. We have a rate of vaccinations that's much more accelerated than I had expected. Okay, and the mobility and engagement improvement in our economy is happening faster than I expected. We've had more fiscal policy pass, not talked about, but pass much more than I'd expected. Okay, which is helping to speed the recovery. And we've been raising our GDP forecast. And as I mentioned to you, if there's a mistake in that forecast, it's probably that it's too low, not high enough. And so what I've said publicly is I think the prospects of meeting, from my standards, that substantial further progress benchmark, it's clear to me it's going to happen sooner than, I'll speak for myself, than I'd expected in December or even January. And I've got greater visibility, and we have, I think, for the Dallas Fed and our group here, we think we have better visibility on being able to reach that. And as a result of that, I think it would be wise to in anticipation of that, begin discussions on adjusting our purchases sooner rather than later. And so why is that? I think it's appropriate. You don't want to be preemptive in starting to talk about this, but you don't want to be so reactive as to be late. And what's the balance? The balance is there are side effects to these purchases. So I'll give you an example, and then I'll stop this answer. But this one side of it, we look very carefully at the housing market. House price, single family homes have appreciated substantially. We're getting up to historically elevated levels. I'm getting widespread reports, in addition, from not only my district, but around the country, that investors are now increasingly allocated more capital to single family homes and competing with families to buy those homes, the so-called cash buyer. I don't think what's happening in the housing market is like, at this point, what happened in 07, 08, 09, but I've also said it bears watching. But it raises the question, are the extraordinary measures we took to buy $40 billion of agency-backed mortgage-backed securities every month, how do those fit in light of what that excess we see going on in the housing market? And all I'm saying is, in light of the fact that I see progress on getting to substantial further progress sooner than I would have expected, and in light of some of the excesses and imbalances that can be created by these purchases, I think it's wise, and I think we'd be well served to be talking about this subject sooner rather than later. And I think we'll be much healthier as an economy when we are able to start weaning off these purchases. Mm-hmm. That's my position on this.
We've got, there are a lot of questions in the chat about, sort of about rates. I guess I would ask you, first of all, do you expect to start tapering before you raise rates? And you were one of the Fed officials to have a dot for 2022 for penciling in a rate increase. What's your prediction in terms of timing of how these things might work? Would you start tapering purchases first, then raise rates? And do you think that 2024 average is going to stand, given what you said about things recovering more quickly than you had expected?
So I've been a supporter of the choreography that we begin adjusting our purchases first, we begin that process, we're going to want to do it. We're going to want it to be very well communicated, give the markets plenty of advance notice, and do it gradually so that it's successful. And then let's put it this way: in the aftermath of the last downturn, we finished the tapering before we started adjusting the Fed funds rate. I'm not going to prejudge that, but I do think we should be starting to adjust these purchases first. And there's one standard for purchases, that's substantial further progress, which means to me, I'll just tell you what I think that means, and then we'll talk about the different standard for rates. For me, it means evidence we've weathered the pandemic, okay? Mm-hmm. Which I think we've got better visibility on, that we're approaching that, and that we're making substantial progress on reaching our dual mandate objectives of full employment and price stability. And that's the standard that I'm watching. For liftoff, while I dissented in September from this guidance, the guidance as a committee we gave was we'd reach full employment, inflation would be at 2%, and we'll be on track to moderately run above 2%. Based on my forecasts, I've said publicly, at least in my SEP submission, we would meet those standards sometime in 2022, which is why I've acknowledged that I had submitted starting to increase rates in 2022. But again, it's subject to meeting those benchmarks. Mm-hmm.
Well, since you mentioned the price stability inflation issue, let's talk about that a little bit, because there are also questions about this. I mean, we've seen, as you've said, a surge in prices, and we see companies worrying about inflation. The markets have been worrying. Yesterday, there were a slew of Fed officials out, including yourself, saying that yes, there are going to be price pops, but that it's most likely going to be transitory or temporary and not sustained. I guess my question for you is, what's your view on when we might know whether this actually is a sustained increase? And what are you looking at? What metrics are you looking at to figure out whether this is really just a, post-lockdown, pop, or something more, substantial?
So let me be precise on what I have said publicly. I haven't come to a conclusion whether I actually have avoided being definitive or too definitive about the transitory versus persistent issue. And why have I done that? Because the truth is, and we do extensive outreach at the Dallas Fed, and we probably doubled that outreach in the last 2 months, specifically on this issue. And based on all that outreach, I think I've said this publicly, the most intelligent comment I can make about this debate is I don't know yet, okay? Certain aspects, and I'll explain why. Certain aspects of what's going on are going to be transitory. The base effects, by definition, are transitory year over year. I talk across industries. Some of these supply-demand imbalances have to do with reopening, getting supply chains back in shape. And many of the industries I talk to believe that in the next 12 months we'll resolve a number of them. But I've also said, and I mentioned this earlier, I am hearing greater uncertainty from a number of those contacts who thought 2 months ago they'd get resolved in 12 months, and they're saying it's going to take longer. Why? Demand is stronger than they'd expected, is one reason why. Prospect of more fiscal spending may be a factor. In addition, we're hearing, particularly in the last 6-8 weeks, widespread reports from companies can't find workers. Mm-hmm. And so we may have some supply frictions on the supply of workers, not only, and mismatches on skilled and unskilled. And so I gave you my forecast for this year. That's our base case. We have alternative cases, which would suggest inflation could be higher, but my base case is still to end the year around 2.25%, 2.3%. But I would say this is one where I personally think it's wise to avoid being too definitive, and I don't feel I need to come to a conclusion about these forces. And I've been a big advocate that technology and technology-enabled disruption, I've been saying this now for the last 5 years, is limiting pricing power of business. That, if anything, is accelerated. So you've got these various forces, and the only I can say is we are going to be very vigilant on it. And the reason it's complicated, you have conflicting forces, and you don't learn a lot from looking at the data. I think I learned most in this issue from talking to context, and I can tell you personally, I'm doing it extensively, and we're going out to hundreds of companies at the Dallas Fed through our surveys and through other outreach, and we'll keep doing that. I think this is a subject we need to be highly vigilant on.
Mm-hmm. Well, that brings me to the issue you raised at the outset, which is, there seems to be this mismatch where you still have, 10 million people sitting out of work, and yet you have, Kentucky Fried Chicken, offering signing bonuses, or, other companies trying to get people to come back to work. There seem to be a lot of factors involved. Schools are not open. There's probably concern about contracting the disease. There's also the more generous UI. What are you hearing in terms of that kind of strangeness where you've got so many people still out of work, and yet companies saying they can't find people to fill the jobs?
So we've been looking intensively at this and trying to reconcile the data with what we're hearing from businesses. Number one, so if the employment to population ratio, just for your audience, this is people working as a percentage of the population, it's gone down about 3.25%, okay? And that's about 8.5 million people. This is February of 2020 versus, the last reported numbers. We think, for starters, 2 million of that 8.5 million people are people 55 and older who have retired, who have decided they are not going to come back. Now, some number of retirements is normal. We think in 18 and 2019, some people extended and they worked longer because we had a hot labor market. So you have some catch up there. But we think you have to take 2 million of these workers, it's very possible, are not going to come back because they've retired. And they're in solid shape. They've made the decision that it's appropriate for them, and they're 55 and old. That's one group. You mentioned about fear of infection and working mothers. Working mothers, by our count, is something in the neighborhood of 1.5 million people. These are not precise, but roughly. We would hope a meaningful percentage of them will come back, but we acknowledge some number of them will choose not to come back. Of the unemployed, and you mentioned the unemployment benefits, we are hearing reports from many businesses and from people who deal with the workers directly, Head Start and other agencies. Somebody who worked at $12 to $15 an hour pre-pandemic is now saying, many of them, I don't want to come back to that job. I don't want to come back. I want higher wages, and I'm getting unemployment benefits, and I'm going to be patient, and I'm going to wait. So we've got these various frictions, but I think what we're learning is, I call it the fog of the participation rate due to COVID. There may be challenges to get back to the participation rate. I think there will be. And got to remember, the workforce overall is aging. And pre-pandemic, I was warning that the participation rate over the next 10 years is likely to go from 63-ish plus or minus to more like 61% due to aging. This is why in the immigration debate and other sensitive debates, we've got to be aware we're an aging workforce. And so those trends are still in force. And so I think there are going to be some real headwinds on the participation front. And so I think what businesses are saying is, we're hearing it's so widespread. I think there's probably a little bit more tightness in the labor force and a little less slack than the drop in employment to population might indicate.
Do you think that, though, in a normal cycle, you would then see wage increases, right? You'd see companies saying, all right, well, I'm going to pay, my waiter more money, or I'm going to pay my,
And we are.
So are you seeing that in your regional area?
We are seeing that, yes. In fact, we are. And I'm hearing from a widespread number of companies, and particularly, for an example, leisure hospitality sector, we said, is reopening. And I'm hearing we're going to pay special bonuses. So then the challenge for many businesses is, because the obvious question, why don't you just pay more? And then they explain their business model may not accommodate it, and they don't know how much of that cost increase they can pass on in the form of price increases to their customer. And this is where a lot of businesses are aggressively looking at technology and other interventions to try to address this also. And we're seeing that in a widespread way.
Yeah, it's really interesting. If folks have questions, they can pop them into the Q&A, by the way.
Can I mention one other comment that feeds on this?
Please.
So normally, and I'll speak for the 11th district, but this is true nationwide, you would get a supply also of new skilled workers that had just finished skill training. Two things I'm seeing alarming. I mentioned one. We're hearing from junior college presidents and superintendents that enrollment's down. And but the second one that's alarming, high school graduation rates in a lot of the more at-risk communities that we serve. I'm hearing from high school superintendents that where, let's say one told me, we normally graduate 85% of our seniors. We're going to graduate 60% this year. Many of them dropped out to care for siblings, go to work, help the family, do something. And the fear is, in order for them to eventually go for skills training and improve their ability to earn, they're going to need to at least get a GED. So we're very involved in our communities that we serve here in the 11th district on raising this issue and convening, interventions to the extent we can be helpful to try to address this, because those are going to help also improve the supply of workers. Right.
Yeah. Well, I mean, I guess the other question I have on that is, you mentioned, working mothers, you mentioned the, some disadvantaged communities, not, Chair Powell has said a couple of times that we may be looking at sort of a new economy, a different economy is, people can't go back to the jobs they had before, either because they have family issues, or because those jobs don't exist, to your point, for technology, or because they just don't have the skills. So what role can monetary policy play in this, and what other sort of tools do you think the government should be pulling to help get people back to work? I mean, you mentioned skills training. I'm not really sure. Maybe you could talk a little bit about what you're doing in Texas, but it's going to be a big issue for people, as you said, who have not graduated high school, or who have not had the opportunity to get on the job training because of the last year.
So there are two prongs to this. Number one, and I think this is very appropriate, part of our new framework, we've codified and acknowledged that going forward, we're going to be less preemptive than in the past. And in anticipating inflation, again, I've said you don't want to jump to the other extreme where you're reactive and late, but we're going to be less preemptive. I think that's appropriate. And we've realized pre-pandemic there are benefits when you have a tighter labor force in drawing people in, incentivizing more training. And so I think that's the one thing monetary policy can do, but I think we're doing that. I think the bigger things are structural. So we play a big role in our community as a convener. Early childhood literacy, access to childcare, beefing up skills training, greater awareness of skills training, access to Wi-Fi broadly in blighted areas. These are all actions that I think will help improve the adaptability of the workforce, the training of the workforce. And I think those are non-monetary, they are not susceptible to monetary policy, but Federal Reserve banks, and we're not the only one here around the country, are playing convening roles in our communities to help assemble private business. May not involve the government, may involve the mayor, may involve private business and nonprofits to help take action to improve these areas. And some of the governmental actions, with support for, greater Wi-Fi, more helping people attend skills training, those kinds of things, I think are high return on equity investments.
There is a question in the chat about long-term scarring. I mean, what's your view on that? Is it too early to tell?
The two areas that we're acknowledging the most is, I guess, there are different types of scarring. these retirements, I guess some might call that scarring, and that people have chosen to leave the workforce. And so if you have a smaller workforce, that's a scar. It may be expected, but it's a scar. Helping working mothers, if we don't address childcare and some of these other issues, that's also scarring. And then I do worry about, for lack of, not to be too dramatic, but a lost generation of students, young and high school, that have fallen behind a year. Their literacy has fallen behind. These at-risk communities where we've got to catch them up. And that's the workforce of the future. So I'm very focused on that, actions that in local communities, because that would also be a scar that we will deal with for years to come in terms of our future workforce.
Right, right. There's a question. It's a very broad question, but I'm going to ask it, see what you say. The question is, so going forward, what is the main objective for the Federal Reserve?
We have a dual mandate,
right.
Full employment and price stability. And for me, on price stability, while we have a new framework and we're willing to tolerate inflation running moderately above 2%, we do have, as part of that framework, a commitment to keep inflation expectations anchored at 2%. So, and that's been emphasized by others. I would emphasize that. But I would add one other thing. For me, it's to achieve full employment price stability on a sustained basis, okay? So to achieve full employment price stability, but where you have excesses and imbalances, you want to watch those, because if those excesses and imbalances get too great, they can threaten the sustainable, consistent achievement of that dual mandate. And that's why I consistently raise these excesses and imbalances. And what do I mean by that? If people in the financial markets are over-risked or they're taking excess risk, it seems benign while it's going on,
right.
But when they decide to de-risk or precautionarily de-risk, as we saw, by the way, in March of 2020, now there were reasons they did that, but if they precautionarily de-risk, means they're going to raise cash, sell assets, and we saw the financial markets and the intermediaries, it puts a strain on them. It can tighten financial conditions. And the people we're trying to help the most in at-risk communities be included, they're the ones that get hurt first when you have these excesses that need to be dealt with. So I'm very conscious that we want to achieve this on a sustainable basis.
So you're saying you just don't want to have a boom market, go market, and then all of a sudden it just, craters.
Well, we've learned from experience, when you have this kind of tightening and you have a step back and a retrenchment, it's those at-risk groups and underrepresented groups that get hurt first and often suffer the worst.
There's an interesting question in the chat about about globalization and trade. It says, are wholesale prices in the US, along with wage pressure, quickly reversing the stall in globalization of the Trump era? Are consumers looking more and more to cheaper goods made in Southeast Asia, widening the trade deficit? I guess it's a good question, in part because it does impact, it factors into the inflation question, and also just the trade balance. I'd be curious to hear your answer.
Yeah, so two things. Technology-enabled disruption is alive and well and accelerating. And I think globalization is still in our future. But one of the things in the aftermath of the pandemic that's happened, we like to use the term and I'm hearing this from a range of contexts, is the historical approach pre-pandemic was just-in-time inventory. They want to limit their inventory investment, they want maximum flexibility, and they were able to do it. Let supply chains and logistics let them do it. They learned in the pandemic that just-in-time may be morphing into, in many cases, just in case. What does just in case mean? Right. Mean I need a reliable source of supply, and I might be willing to pay more for it in order to domicile it either here or maybe more likely in Mexico than in Asia, for example, so that in a crunch, I've got more reliable supply. Just in case is a higher cost approach than
Right.
just in time. And it's going to get reflected in at least higher costs. Whether they can be passed on to consumers depends on the industry. But I am hearing that trend widely. But globalization is still going to be a critical aspect of logistics and supply chains. But I think, again, this just in case is going to be happening with greater frequency. And I'm hearing that broadly.
You've mentioned technology disruption a number of times. I'd be curious to hear from you. You know, we see companies, especially in the wake of COVID, you know, saying we're going to do more drive-throughs, more automated, you know, McDonald's, Starbucks, you know, fewer employees.
Yeah.
What is this? What are the ramifications of this for both the economy and for the labor force participation rate?
And by the way, those are the examples you can see. I'll give you another example is think of the call center worker that makes 55 grand a year. You know, most of those jobs over the next 3 to 5 years are going to get replaced by technology. Those people are going to have to get retrained or find other work. So what are the implications? And we do a lot of work, and we have a conference actually in the next 2 weeks at Dallas Fed, our 3rd annual conference on this subject, which people are invited to attend. What we said is this: if you've got a college education or greater, technology investment and technology-enabled disruption, either disruptive platforms or people replacing, businesses replacing people with technology, you'll probably adapt to it. Might create traumas. You might have to change jobs, may affect your industry, but you've got the skills and the education to adapt to it. Mm-hmm. What we're finding, and it may help you improve your income and your income growth over your career. What we found is the issue is with high school and less educated workers who don't have a specific skill. Here's what technology impact it's having on them. Their job is being increasingly disrupted, restructured, or eliminated. And they're on the receiving end of this. And they're going from that call center at $55,000 a year to a lower value added job unless they go get retrained. But to a 45-year-old worker, it's a lot easier for me to sit here in a studio and say, you should go get retrained. It's a lot harder to do. And they may find that their next job makes less, is less productive. And so the reason we think our thesis here is why you haven't seen greater productivity improvements is because, not because they're not happening, it's that high school and less educated workers are not sufficiently getting the benefits of it because we're not making training and retraining as accessible. And we've got to improve the adaptability of our workforce to get the most out of these technology investments. Mm-hmm.
There are a few questions in the chat about, you know, taking away the punch bowl. I guess I want to frame it. You know, will the Fed take it away will they be too late? I guess I wanted to ask you a little bit and frame it a little differently. You didn't sign on to the policy framework review, as you mentioned.
I backed the framework. What I didn't back is the guidance gave in September, which is separate than the framework. I voted for the framework. I'd still vote for the framework today. I endorse it. Where I disagreed is the implementation of the framework.
And is that because you think it gives the Fed less flexibility to raise rates?
Yeah, so here's what I disagreed with. You remember, for those that, what we're talking about, in September, we committed to keeping rates at 0 until we reach 2% unemployment, full employment, full employment, 2% inflation, and run moderately above. What I said is, as the neutral rate increases, as it is now, by the way, and you're approaching full employment and price stability, the neutral rate will go up. If you insist on keeping the Fed funds rate at 0, you're actually increasing accommodation, which would be analogous, for lack of a better one, is you're approaching an intersection. You're not tapping on the brakes. You're not even letting off the accelerator. You're pressing down on the accelerator. Mm-hmm. And normally I try not to drive that way. And I'm not a great driver, but I try not to drive that way. And what I said is I'd rather leave it to future committees to have the flexibility to be highly accommodative. Mm-hmm. But that doesn't mean necessarily keeping rates at 0. And I don't know that I would sign on to committing in advance to increase accommodation as we're approaching full employment price stability. I don't know that future committees will think that's sensible because I question that approach. But again, I'm happy to leave the flexibility, but I emphasize there's a difference between being highly accommodative in order to achieve our framework versus committing to keeping rates at zero. And the framework is silent on rate levels.
Right.
So my interpretation is we should remain more accommodative than we've been in the past, but I don't think we should committing in advance to rates at zero in future periods where we really, I'd rather leave it the judgment of committees to debate that out rather than commit to today to being zero in the future.
Do you think it makes it harder for the Fed to pull back, in time before we get to what you talked about before, which is the boom bust?
I think this issue, it's one thing, again, and I've said this, to avoid being preemptive or too preemptive. That's one thing. But you don't want to go to the other side where you're reactive and late, because we found, yes, we have the tools to deal with excesses.
Right.
If you use them late, they tend to have a pretty jarring effect. And I think my own experience in 5.5 years at the Fed is if you employ them gradually and along the way, you can smooth the path and make it more likely that you achieve full employment and price stability in a sustainable way. If you do it where you're using those tools late, it can have a jarring effect where it may actually impede your ability to achieve full employment and price stability.
I want to switch topics for a minute and talk a little bit about climate change. The Fed has been talking more and more about climate change and has gotten some pushback from Republican lawmakers who have said, that they need to be careful not to wade into, what they say are social issues, and that the Fed's focus on this could actually dry up credit for the fossil fuel industry if banks feel like they have, they're going to be judged harshly for holding those loans. Given you are in the heart of oil and gas, fossil fuel country, I would love to hear from you your thoughts on the Fed, the role the Fed should be playing in climate change, and what the industry is actually thinking about in terms of what the future holds.
So it won't surprise you. I would guess the Dallas Fed has the largest energy group in the Federal Reserve System, as you would expect, because we've got the largest. We're not only the largest fossil fuel producers, we're among the leaders in wind, solar, and other types of energy. And so we've been working on this for several years. And here's the reason why. Number one, we're on the receiving. So I would put all this discussion of climate change and sustainability in the context of reaching our dual mandate. We don't have a new mandate, full employment and price stability. In order for me to understand economic conditions in the 11th district, I better understand hurricanes, floods, threats to petrochemical and refinery infrastructure along the Gulf, threats to the channel itself. I spent a lot of time with the head of the port, and that person tells me we are 1 or 2 storms away from impeding shipping along those channels. And Hurricane Harvey and other severe weather events have, $70–80 billion impacts. So number one, we've got to understand it. Number two, we also think it's very, very critical as we aggressively move to wind, solar, battery storage, other alternatives. Our own estimates, even with the most aggressive assumptions, the world is going to be relying on fossil fuels, not for the next few years, but likely for the next 2 or 3 decades. And so as we make this transition, you're going to want a healthy fossil fuel industry, one that, yes, invests more in sequestration, greenhouse gas emissions limitation. And the industry is way ahead of what I'm saying. They're all over this. You're going to want that because if you don't have enough supply to meet the fossil fuel demand and you have price spikes, it's going to affect millions of consumers in the United States. And again, those maybe who are least able to weather it. Yeah. And then, yes, lastly, there's the financial stability. Financial stability is part of our mandate. And, this most recent cold spell freeze, not much lots been said about it. There hasn't been much written about the fact there were double-digit $billion of counterparty losses because of the spike. So it reminded us here that if you had a severe climate change event, that lasted for more than a few days. That only lasted a few days, and maybe we saw 12 to 15 billion of counterparty losses.
Yeah.
Better understand those exposures because they could affect financial stability. And so that's the context and why we're doing it. I don't think I can do my job as head of the Dallas Fed without understanding and spending a meaningful amount of time understanding climate change, sustainability, and its implications. I needed to understand economic conditions and financial stability in order to achieve our dual mandate, though. It's all in service of achieving our dual mandate.
You mentioned, so hurricanes and flooding. President Biden is in Louisiana today in Lake Charles to sell his infrastructure proposal.
Right.
And I'm curious for your thoughts on, the need for infrastructure and whether you think that, that this is a smart use of fiscal policy. Is it, should it be paid for? Are you worried about the deficit financing aspect?
So it will not shock you that I will stay away from the fiscal debate and all the elements of pay for and everything. It's not appropriate for me as a central banker. Having said that, we have done a fair amount of research on the impact of government spending on government spending that impacts consumption versus government spending that creates more sustainable GDP growth. And the one thing, and I've said this publicly about infrastructure, is if you make an investment in Wi-Fi or roads and bridges, as long as they're needed projects, that's an investment that could have a 20 or 30-year return in terms of improving productivity, which GDP growth is made up of growth in the workforce and growth in productivity. And so I would differentiate that kind of spending on infrastructure, needed infrastructure, because it actually may improve sustainable GDP growth, potential growth. And so I differentiate it from spending that funds consumption and current spending that gives you a bump, but you head right back down to trend growth. And so I think there are real benefits, if it's done well, to infrastructure spending.
I mean, especially given what Texas went through with the grid outage, right? There, do you see that as infrastructure? I mean, there's a debate over what is real infrastructure, right? So
yes, that's real infrastructure. And listen, we have to face, in this country, we have an aging population. We have a high level and growing level of government debt. We've got to grow faster. So how do you moderate debt growth? One is you can do sensitive things like entitlement reform and other debate issues, but higher GDP growth also helps moderate debt growth. And we need higher productivity. We need more workforce growth. We need better education, better productivity. Infrastructure investments could help you get more sustainable GDP growth. So that's something I've called out as something different than just general government spending.
We're almost out of time. There's been a couple of questions in the chat about shadow banking. I'm curious if you have thoughts about that.
I do.
Okay.
So here's the issue. The Federal Reserve has jurisdiction over commercial banks. We have tough capital requirements. We have very tough stress testing. Not perfect, but dramatic improvements since the Great Recession. We don't have great visibility on the non-bank financial system, and we don't have jurisdiction. And there isn't tough capital requirements or stress testing. And so when I talk about excess risk-taking, there's certain things I can see, and there's certain things I can't see. So what's an example? I can see what the amount of margin debt is. I cannot see, and I don't have good visibility on use of derivatives, total return swaps, other mechanisms to create leverage. So I have said, if there are financial stability issues down the road, I'm much more worried about the non-bank financial system. And I'm particularly worried not about what I can see, I'm concerned about what I can't see. And I remember back to the Great Recession that there was some estimates 70 to 90 trillion of credit default swaps out. And there wasn't great visibility that existed. We ultimately got visibility, but too late. And so I think more visibility, I'd be supportive of more visibility through reporting other ways on the non-bank financial system. And this is why, back to some of the excesses that can be created, I pointed out we need to be worried about excess risk taking and other imbalances, particularly in the non-bank financial system, because we can't stress it and we don't have great visibility on it.
Well, and it actually had a practical impact last March, right? When you saw all of the volatility happening, and, there's still a debate about what actually happened, whether it was hedge funds, unwinding, So I guess.
And by the way, when vol is low,
mm-hmm.
and there are various reasons why vol is low, but our purchases can be one factor. Most people do their risk budget based on vol. Higher the vol, they reduce risk. Lower vol, they take more risk. And so when I talk about incentives to reach for return or put on more risk, we just have to I just want to be cognizant that there are many factors, but Fed purchases may be one of those factors.
Mm-hmm. But you're talking about having more, I guess, visibility into what these non-banks are holding, what kind of positions they have.
How they're positioned.
Versus sort of bringing them under the Fed's purview. And
they're not going to come under the Fed's purview, and that is, but they should be under someone's purview. Yeah. Because increasing amount of the financial system is moving out of the regulated sector into the underregulated sector. We should just call that out mm-hmm. and be aware of it.
The last question I have before we have to go is, you talked a little bit about the digital divide. We had this sort of devastating story in the New York Times yesterday about a child in Mississippi who basically doesn't go to school because his mom has the only phone that he can use to log on. You talked about a lost generation. This must have huge ramifications for sort of the macroeconomic forecasts. How are you guys thinking about sort of the impact on schooling and this year, and the lack of the lack of momentum that a lot of students are now experiencing going forward?
I'm very concerned about it, and I've been very vocal that I'm concerned. Here's why. As I mentioned, GDP growth is growth in the workforce and growth in productivity. And let's say growth in the workforce we know is decelerating. Maybe it's going to be 1/4 to 1/2%, for example. The rest has to come from productivity. Mm-hmm. So let's say productivity growth is 1.5%. That gets you to 1 3/4 potential GDP growth. And so the most valuable asset we have in this country are our people. And these young people, 0 to 18, 25, making sure they get to grade level by 1st and 3rd grade. If they've fallen behind, get them caught up, because that's the workforce skills training down the road. Mm-hmm. That's the workforce of the future. And to the extent that they can have better literacy and get trained, we'll have higher GDP growth. So this Wi-Fi investment, to me, is at the top of the list, and high return on investment, equity investment we can make. Also getting kids 0 to 5 with reading programs early, pre-K, mm-hmm. all that is a high return on equity investment. And why? Not that it's a nice thing to do. It's a high return on equity investment. We'll all prosper more if we invest in these kids.
Especially given what you've said about the aging demographics and, the fact that we need more people. we need more workers.
And we need more workers, and they have to be more adaptable and better trained and more literate.
Well, thank you so much. This has been a wonderful conversation. I really appreciate it. I learned a lot. So, and thank you to the folks who asked questions. If I didn't get to your question, I apologize. But I think this was a very nice discussion. So thank you. And thank you, Dimitri, for the opportunity.
Thank you very, very much, Mr. Kaplan. And thank you, Deborah. This was excellent.
Thank you very much. Enjoyed it.